U.S. equity markets enter the first week of June 2026, sitting near absolute record highs. This chart shows the S&P 500's relative strength index. As the index crosses into the 73 threshold, it signals structural overbought conditions that leave current valuations vulnerable. Those valuations face immediate pressure from a massive wave of incoming data, including critical labor market updates, major enterprise tech earnings, retail consumer health reports, and shifting global trade dynamics. Every release this week acts as a stringent stress test, setting the absolute baseline for the Federal Reserve's impending June 16th policy meeting. This calendar tracks early labor indicators. Tuesday's JOLTS projects flat job openings at 6.87 million, followed by Wednesday's ADP holding steady at 110,000 additions. Friday brings non-farm payrolls, projecting 102,000 new jobs, 4.4%. The margin for error is razor thin. A hot print erases expectations for near-term rate easing, while a miss below 70,000 additions instantly triggers domestic recession fears. With prediction markets pricing a 96.9% probability of a policy hold this month, this week's labor data is the sole variable capable of forcing the central bank's hand. Beyond the labor market, enterprise technology stands as the primary anchor for market valuations, with critical semiconductor and cybersecurity earnings dropping this week. This dashboard tracks enterprise capital expenditure. Reports from Broadcom, CrowdStrike, and Palo Alto Networks will dictate if aggressive AI investments generate sustainable, high-margin revenue. Contrast that heavy enterprise spending with the consumer economy, where high interest rates continue to apply severe financial friction. Late-week earnings from Dollar General and Ulta Beauty will quantify this strain, exposing how 3.8% headline inflation impacts lower-income households while eroding premium spending among wealthier shoppers. This chart shows two opposing trend lines in construction spending. Traditional residential building stalls under heavy mortgage rates, while commercial outlays for data center construction accelerate sharply. Prolonged high interest rates are forcing a clear reallocation of capital, draining discretionary spending from the everyday consumer and funneling it directly into technological infrastructure. This chart shows the U.S. trade deficit narrowing to $82.4 billion, supported entirely by record daily shipments of 6.4 million barrels of petroleum. Expanding the data reveals a continuous surge in imported capital goods, now facing new tariffs that threaten domestic manufacturing margins. Additional pricing pressure comes from the Middle East, where proposed peace drafts for the Strait of Hormuz and parallel frictions in Lebanon are introducing wild swings in crude oil benchmarks. The domestic energy boom insulates the U.S. currency, but supply chain hurdles and shifting tariff brackets risk forcing logistics costs directly onto corporate balance sheets. Facing this packed calendar, fixed income desks position defensively, driving the 10-year Treasury yield upward to hedge against a potentially hot jobs report on Friday. That upward drift in the bond market acts as an immediate restrictive headwind, keeping the valuation of rate-sensitive equity sectors on a tight leash. The market faces three definitive hurdles: a nearly locked-in central bank policy hold, a reliance on enterprise tech to justify equity multiples, and the absolute necessity of an orderly labor cooling this Friday. Institutional traders must absorb the immediate macroeconomic data drop, look past the June meeting, and position for a test of broader market stability heading into the late autumn.